Good morning and welcome this morning to Getting Started with Options. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. Joined out there in the chat by my good friend Mike Fairborn. And Mike's a 20 plus, going on 30 plus year veteran of the financial markets. Who am I kidding? Still looks like Matt Damon and is, the alter ego for Jason Bourne. But we're glad to have Michael with us to help answer questions out there in the chat and keep that conversation going. Thanks to all of you for joining us. And whether you are here in the live version or the recorded version, we appreciate you being here. Be a part of the conversation by leaving us a comment in the comment section or chatting in a question if you're here with us live. We're going to be talking today about lesson number 4, covered calls. So we shift our view from being the buyer of an option to being the seller of an option. And it entails a bit of a mind shift. We're going to talk through that today in this discussion. We're going to look at a couple of examples of covered calls, and that's going to set us up for the next step, which is cash secured puts. So our focus today, covered calls. Let's jump out here real quick and talk about a couple of quick housekeeping items that we need to make sure that we're aware of. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation or advice about a particular security or strategy or account type or anything else. Remember that options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option transaction. Also, since we're talking about now being short an option instead of being long an option, there is the potential, anytime that you are short an American style option, to be assigned that obligation that short position entails. So if you're short a call option, meaning we've sold a call option, which is what a selling a covered call is, there is that possibility that you could be assigned the obligation to deliver shares of stock. Now, a couple of notes about that. One, that potential could happen in an American style option at any time prior to expiration, regardless of whether that option is in the money, at the money, or out of the money. Number two, it's important to remember, we're going to be using the Thinkorswim desktop software platform, specifically the Paper Money platform. But Paper Money does not facilitate the early assignment of short options. So if all you ever do to practice is trade covered calls in your Paper Money account, you're not going to experience that potential early assignment. It's just not going to happen. The Paper Money platform does not allow that to occur. You might move your practice to a live trading account and you get called out and your shares get called away. And it is something that you need to be aware of. Now, another consideration is that covered calls only provide downside protection to the extent of the amount of the premiums received. We'll talk through that idea as we get into this discussion. And one of the considerations in trading covered calls is the idea of being able to roll that short position, meaning close down the one that you're in and then initiate a new one, doing it in one transaction. That rolling strategy can entail additional transaction costs. It is not a magic wand. It doesn't eliminate fees or anything else. And it is dependent upon the liquidity of the target that you are rolling into. So something to be aware of. Again, this is the probability analysis, the technical analysis that we're going to use. Those are all theoretical in nature. None of those are guaranteed. There's no guarantee that the execution of a stop order will be at or near the stop price. Past performance, no guarantee future results. Let's jump over here into a couple of these slides and kind of talk through this process. And I just want to mention this, if for those many of you that are joining us in this discussion today, you may very well already be experienced in trading covered calls, which is great. Stick with us because there are likely going to be some nuances that we will talk about in this discussion that will help you to understand the strategy a little bit more. For those of you that are brand new, this is the place for you to be, because we're continuing this process of learning about options. We talked about the introduction to options, option Greeks. We looked at long calls a couple of weeks ago. Last week we looked at long puts. Today is covered calls. Next week we're going to do buy right covered calls, getting a little bit deeper into the strategy. And then we're going to get into short puts, and then we're going to start putting those building blocks together into spread trades. So today we're going to focus on the basic strategy of covered calls. This is lesson number 4 out of 12 in this Getting Started with Options series. Now, what you'll see is along the way, a couple of times we'll have some one-off type lessons in this discussion, but this is our general format of how we will go through these ideas. So we are on lesson number 4, covered calls. So what and why? What are covered calls? Why do we use them? We'll talk through the basics of doing a covered call trade. We'll look at a couple of examples of how we might place a trade. And we'll talk about some next steps to accomplish. So once again, thanks to all of you for being here. I love seeing those hearts out there because I know that Janelle is in the chat there, which is awesome. I love having her in the chat and the enthusiasm and energy that she and all of you bring to this discussion. So let's jump in to the next step and let's talk through this idea of what and how a covered call works. And I refer to this oftentimes, if you've been to one of our live events, our technical analysis and option strategies workshop, I oftentimes refer to covered calls as kind of the gateway drug, if you will, to options trading, because for many traders and investors, covered calls are the first type of option strategy that they may employ. We spend a little bit of time talking about being the seller or the buyer of an option and speculating on price movement. This time, we're really focusing on the primary focus, which is on the ownership of the underlying stock. That's the big driver in the trade. And then selling an option to bring in some additional premium. So that's what it means to sell a covered call. A covered call indicates that the trader or the investor owns at least 100 shares of stock for each call option contract that is sold. Now, remember, when we sell a call option, we have an obligation to deliver or sell shares of the underlying stock at the strike price at any time up until that expiration date. And in exchange for that, we get a premium. We bring in cash, essentially. So it is a trade where there is, if we didn't have the ownership of the underlying stock, we would have theoretical unlimited risk, because the price of the underlying stock could go way up and we'd have to deliver the shares at the strike price, and the price of the stock that we'd have to go out and buy the stock at might be significantly higher. But if we already own the underlying shares, now this becomes a position where if we own the underlying shares, have the cover for the obligation that the short option entails. So the goal here is to generate income, to bring in premium time after time after time after time. We sell the covered call, bring in the premium. The idea being that we sell the call option when it is expensive, and then we either buy the call option back when it is cheap or it expires worthless, or we end up having the shares called away from us. That is another potential exit strategy for a covered call position, because some traders will use a covered call as a means to exit a stock that is going higher and get paid for the opportunity to sell the stock at that higher price. And if it doesn't get to that higher price within the time span of the option trade, then being able to bring in that premium and then do it again. So generally, this is a bullish strategy, maybe bullish to neutral, not necessarily a bearish strategy. And I know there was some mythology about covered calls being bearish strategies that had been running around a few years ago. Trading covered calls is generally a bullish strategy because, you remember, in order for it to be a covered call, the trader has to own the shares of the underlying stock. So that inherently is a bullish position, owning the shares of the underlying stock. So that doesn't mean that the stock is going to go up. It just means that the intent for owning the shares, aside from something like dividends or shareholders' rights, which aren't guaranteed, dividends can and do change and may be stopped, but the covered call is another way to perhaps generate income on underlying stocks that are generally appreciating in price. Maybe they generate dividends as well, but it is a strategy that can be used as an income stream. And I like what Andrew says, covered calls are win-win-win. Not often, not always, because you can lose with a covered call strategy. You could be called out of stock that you don't want to be called out of, for instance. And there is risk, and the risk is essentially in the ownership of the underlying stock. And Rita brings up a good point too, because this is the other risk of a covered call. And she says this, in this market with such quick movements, hate to sell covered calls because it caps the upside. That can certainly be frustrating, having that artificial limit on how far the stock can go. But one thing to keep in mind, if the stock continues to run, as long as you've not been called out, there's the possibility of buying back that call option. Might cost you a little bit, but eliminating the obligation and then letting the stock run. So we'll talk through that idea as we get into this strategy as well. Yeah, and Bogus says, yeah, it is a limited profit when the stock runs to the upside. So the benefit is we collect that income. We provide a little bit of protection to the downside. A lot of times investors and traders will use covered calls depending on their level of activity and how active they want to be in managing the strategy. May trade covered calls on a short to intermediate term basis, but there is also an argument to be made for trading covered calls on a longer term basis, just being a little bit different in terms of how you select a strike price to sell. Now, the risks that we just talked about, and as Andrew brought up and Rita brought up and a few others, it limits that potential upside gain. You might get assigned early and have those shares called away. That might trigger a capital gain or a tax implication or sentimental implication. And it's not really a great necessarily downside protective position. But it can be used to help finance a protective position. We'll talk a little bit about that as we get into some of these. So a couple of other additional considerations, and then I'll address Rita's question. So the question you have to ask is, am I really, truly, honestly willing to sell these shares of this stock? Because if you can't answer that in the affirmative, maybe it's a position you probably ought not, or maybe ought not sell a covered call against, simply from the standpoint that there is that possibility that those shares could be called away at any time prior to expiration. Now, is it likely all the time? No, it's not something to worry about. It's just something to pay attention to. You have to be aware of the calendar. When are dividends coming up? When are earnings announcements coming up? And it's a volatility trade as well. When implied volatility is high, we've talked about the idea of movement of implied volatility. When implied volatility is high and falling, that definitely can potentially benefit covered call sellers. Selling when the option is expensive and then buying it back when it's cheap because of implied volatility may be a part of the strategy. So you have to be aware of the risks. You have to be aware of the challenges. So I wanted to bring up Rita's question here. Maybe sell covered calls on indexes. The European style makes it easier to manage. Well, you're right. You don't have that early assignment risk, but index options are a little bit different animal because index options are cash settled. So you can't own the underlying index. You would have to have cash available in your account. So selling a covered call or selling an index option still has that naked risk, but you've got cash in your account. The problem is you don't know how far up the index can go. So that becomes theoretically unlimited risk. We'll talk as we get into things like vertical spreads, how we might manage that risk. But the idea behind that is sound, that a European style option doesn't have that early assignment risk. So, but you can't own the underlying index, so you can't have a true covered call on an index option. Bill points out you drops the cost basis of stocks owned. So cost basis is a tax term. It drops the net cost of owning the stock, essentially the same thing, just different way to express it, because you're bringing in premium that offsets how much you may be paid for the stock to begin with. So, and A&Q asks the question, so what strategies can you use to minimize the possibility of the stock being called away? We'll talk about that as we get into this discussion, because that is an important consideration. If that is the biggest concern, the first question is that, am I truly willing, honestly, willing to sell these shares of underlying stock? And if you can't answer that positively, maybe don't sell a covered call against those shares. Second way to minimize that possibility of the stock being called away is being selective and appropriate when choosing a strike price to sell. We'll talk through that idea as we get into this discussion. So here's how the risk profile for a covered call looks. Owning an underlying stock has kind of that diagonal movement in terms of profit and loss, moving from loss to profit as the price of the stock goes up. But when we sell a covered call, when we put a call option in there and we sell that, that gives us an obligation to sell the stock at a particular strike price, then that caps that upside potential gain. So that's why we get this kind of distinctive upward slope and then horizontal top at our maximum theoretical gain. The max loss is the ownership of the underlying stock going all the way to zero. That's where the real risk is in a covered call trade, is the price of the underlying stock going all the way to zero. Not necessarily in having the shares get called away. As long as you can answer that question in the affirmative, am I really, truly, honestly willing to sell these shares of stock? Now, it also reduces potentially your break-even point in the ownership of the underlying stock. So your original stock purchase price minus the call premium received is going to be your new break-even point in the ownership of that underlying stock. So that goes back to Bill's point, drops that cost of, or that break-even point, let's refer to it that way, in owning the underlying stock. So what are some good candidates? Stocks that appear to be in a neutral or sideways trend. Now, there's a reason why a trader may own those shares. Again, price appreciation, the primary reason, but dividend generation also is a consideration. But when you start talking about the stocks to trade covered calls on, generally bullish underlying stocks that are maybe in a shorter term neutral or sideways pattern. Stocks that are approaching a resistance area, maybe bouncing down from a resistance or showing a close below the low of the high day. In general terms, stocks that are liquid, meaning they're trading where the people are. Stocks that have higher trading volumes, narrower bid-ask spreads. Options that are liquid as well are important. So you may own stocks that trade in a liquid fashion, but maybe they don't have listed options. Obviously, you can't sell covered calls against them. You may own stocks that trade in a liquid fashion that have illiquid options, where it might not be beneficial to sell covered calls against those stocks. So all of these are considerations, right? Underlying stock volume, option trading volume, open interest and volume, and tight bid-ask spreads or narrow bid-ask spreads on the options themselves. So let's kind of put this together. Time frame for many options traders that are selling covered calls are expiration dates typically 50 to 20 days to go until expiration to benefit from relatively rapid or the beginnings of rapid time decay. Further out of time, you're going to collect a little bit more, but they're not going to go away as fast. You're not going to see as much of a decrease in that option premium, being able to buy those options back at a later date for less than you were paid for them to begin with, as quickly as if you're selling in that 20 to 50 day time frame. Now, that is not a rule of thumb. That is not a suggestion or a bit of advice. That is simply a consideration. Some traders, if they are less active, may sell longer dated call options further away from where the price of the stock is trading so that they don't have to manage them as often. Some traders feel comfortable selling covered calls on a much more frequent basis, shorter time frame to go until expiration, but they might sell closer to the price of the option or the price of the underlying stock in order to bring in enough premium to make that type of activity um, profitable or worthwhile. Now, in terms of strike selection, when we talked about prudent or appropriate level of strike, some traders will use technical analysis and determine a level of resistance that they sell at or above. They might choose to use a delta location. Remember, delta being the approximation for probability of the option being in the money at expiration. It's also, remember, that also that projection of the sensitivity of the option to directional price movement. And position size is something to pay attention to based on the underlying shares of stock. Okay, so let's do this. Let's pop out here. I'll come back to this slide, but let's pop over to the Thinkorswim desktop software platform. First thing I want to do really quickly is just review where we are in terms of implied volatility, just to set our expectations. This is the VIX. We've talked about the VIX before. The VIX is the measurement of implied volatility overall for the S&P 500. It's the general kind of consensus of, are options expensive or are options cheap? Individual options are going to have their own levels of implied volatility. But overall, right now, implied volatility is down in about the 17 handle, meaning it's trading about 17 points. That suggests in this relative range where the average for implied volatility for the last year is about 17, almost 18. We're a little bit below that average for implied volatility. These aren't hugely expensive. They're not really, really, really cheap either. So implied volatility is just kind of hanging out at this point, which is surprising given the fact that we've got geopolitical risks running amok at the moment. But implied volatility digests, the market digests those risks pretty quickly. When you see those big volatility spikes, they tend to bleed off very quickly. So implied volatility is not very high. That means overall, the level of implied volatility is probably not going to be enormously high for stocks that traders might sell covered calls against. But remember, each individual stock has its own level of implied volatility. So, but don't, this is kind of setting that stage for saying implied volatility is not huge at the moment. Now, let's take a look at an individual stock. I'm going to change this grid to my single grid just so that we can kind of walk through this. And I'm going to change this to an individual stock that some traders might be familiar with already. And this is a stock that some traders might have in a portfolio. I think we've talked about this particular stock on a couple of different occasions. I'm just going to remove a couple of these lines. But generally, this is a stock that is in a bullish uptrend. It is a dividend. I think it is at least a dividend aristocrat. It may be a dividend king, and maybe Mike can remind me if it is. I think it is a dividend king or dividend aristocrat. 25 years plus of consecutive dividend increases. Dividend king, 50 plus years of dividend increases, and I think this might be a dividend king. So some traders might be buying this and owning these stocks. This stock for the purpose of generating income. Some traders might be buying this stock because it's been moving in a bullish direction. Now it's kind of been going sideways for a couple of months. In fact, it's pulled back from some of these recent highs. Started to run back up again a little bit here. Now maybe pulling back just a little bit. Now there's a dividend that just got paid. So we saw the price of the stock adjusts down for that dividend. We're past the earnings announcement. Implied volatility for Johnson & Johnson is relatively high, and it looks like it's starting to fall. It fell post the earnings announcement. It's staying kind of, it's moderate implied volatility. This is not going to be a huge premium payer because this stock is just not as volatile necessarily overall as some maybe growth stocks, some of the technology names growth stocks. Okay. So AB Wolverine asks the question, is it always 100 shares of a stock to be able to sell covered calls? And the answer to that is yes, assuming you're selling standard options, which are reflective of an obligation to deliver 100 shares of the underlying stock. There are smaller options contracts, not very, very many of them, but there are options contracts that are reflective of 10 shares of stock. Those aren't very liquid. Um, but I suspect, if demand continues, you may see some of those smaller contracts continue to get listed. But in this particular case, and with this as an example, this is Johnson and Johnson. Standard options are 100 shares. So you got to own 100 shares of the underlying stock to be able to sell a covered call and consider that obligation to be covered. Got to have 100 shares of the underlying stock. And by the way, that 100 shares has to be in the same account in which you are selling the covered call. You can't sell the covered call over here and own the shares of the underlying stock over here in a different account or a different broker or something like that. You got to have them in the same place in order to be able to provide the cover for that obligation. So we've got 100 shares of Johnson & Johnson in this particular account. So what we're going to do is we're going to look at selling a covered call on Johnson & Johnson. So what I'm going to do is two things. I've already identified the trend of the stock. I've already identified where implied volatility is. I know that it's high and relatively high and falling. But I'm going to come in here and I'm going to determine if there is a level of resistance that I need to pay attention to. And I'm going to make the argument that there's probably a level of resistance, maybe right up here at around this 235 level or so. Okay. And Wiley says, yeah, you're absolutely right. You can sell a call option against a long call option and create a diagonal spread or a vertical spread, which we're going to get to in a couple of sessions in this webcast series. But I've got this resistance level up here around 235. I've also got a level of resistance maybe up here around, I'm going to call it 250, just kind of right up here as a level of resistance. So we've got 235, we've got 250 as resistance levels right there. So if I'm going to look at selling a call option, and my goal to this covered call is to not have the stock go in the money, then as a trader, I'm going to be looking at selling at or above a level of resistance. So if I sell at or above 235, I'm going to bring in more premium. If I were to sell a call option at or above 250, I'm going to bring in less premium because it's further away from where the price of the underlying stock is sitting. And the answer to Shelley's question is yes, these are being recorded, these are available. I'll show you where to find them here in just a minute. Okay, so we're going to sell this call option right out here at around the 235. Maybe we'll go to the 250. We'll look at the difference. In terms of time frame, remember we said 20 to maybe 50 days to go until expiration. So we're going to pop over here to the trade tab and we're going to look at Johnson & Johnson and we're going to look at those expiration dates. So I'm going to kind of come right back down here. I'm going to go out, first of all, the way longer end of that spectrum. That's out here at around that July 17 expiration. That's 52 days to go until expiration. Means that we don't have to manage it as much, but we're going to get paid a little bit more, but time decay is going to be a little bit slower. So we're going to go to that 17 July expiration, and we're going to look at the call side. Remember, we're talking about call options here. So looking at my call options, I know that I've got a 235 resistance. So if I were going to look at selling the 240 strike, that's going to give me a premium of about $4.70. So I've got about an 80-cent wide or 75-cent wide. I'm sorry, about a 35-cent wide bid-ask spread here. Not huge, but not especially narrow. This is a fairly liquid stock. So I might be okay doing that. I might even go a little bit further here because out of the money, selling the 250 strike, I'm going to bring in less premium, but I've got a narrower bid-ask spread. But look at this. This is a strike where I've got 147 contracts already traded today, 355 contracts traded today on the 240 strike, and I've got multiple thousands of contracts in open interest. This is not an illiquid stock, and nor are these illiquid options. So I'm going to change my layout. Now that I know what that volume and open interest is, I'm going to change my layout to Delta, Theta, and Vega. Delta, Theta, and Vega. So some traders will use kind of the 20 to 30 cent delta as a starting point, as a point of consideration, not a rule of thumb, just a point to begin the conversation. Um, and some traders will do that in combination with what we did with the technical analysis. But here I am at that 240 to 250 strike, maybe the 260 strike. But you can see that if I were to sell that 240 strike, the price of the stock could move up through that level. It's a little bit closer to where the price is currently trading because we're at 231. Now that's 9 points away from where the price of the stock is at the moment. If I go out to the 250 strike, that's 19 points away. That's almost 20 points away. So it depends on how likely you are to think that the price of the stock is going to continue to go up versus how much premium you're willing to bring in. So perhaps a more aggressive covered call trader that is not as concerned perhaps about having the shares called away might look at selling the 240 strike and bringing in more premium versus perhaps a bit more conservative or less aggressive covered call seller that might look at selling the 250, bringing in less premium, but less probability, lower probability of having those shares called away. And that's kind of the trade-off that we have here in this particular case. If we think about it just in terms of that probability expression using delta, the 240 strike has about a 36% probability of ending up in the money at expiration. The 250 strike has about a 20% probability of being in the money at expiration. So about a 16% difference in those probabilities for about half the premium. So some traders may be willing to take that higher probability of ending up in the money and just be more active in managing the position. Some traders are less hands-on and maybe would go with the 250 strike. So in this, for our example, I'm going to choose that 250 strike. I'm going to look at selling that 250 strike at or above that level of resistance that we drew on the chart. And I'm going to bring in theoretically about $2.08 of premium per share times 100 shares. And that's going to bring in a premium of $208, which means that my break even is whatever I paid for the shares of the stock now minus $2.08 per share, or $208. Doesn't seem like a lot, but I mean, that's what, 2% roughly, maybe, on the price of the stock. So that being the case, again, I'm not giving you any kind of recommendation as far as how much premium to bring in. But what I want to do, let me edit this real quick. I want to see where I've got my Johnson & Johnson shares here. Those are in my stocks group. So I'm going to come back to that order. Click on confirm and send. I'm going to put this in my stocks group just so that it goes into the same place. Now we're going to look at selling this option to open. And we fired that order off. We are now short one contract of the Johnson & Johnson. Let's go to our monitor tab here. Here's Johnson & Johnson. We are short one contract of the 17 July 250 call strike. We brought in $2.16, and our expectation is the price of that option is going to get cheaper as time passes. Then at that point, as we get closer to expiration, we can look at closing that trade down, either by buying that option back and eliminating the obligation if it's at or out of the money, maybe even if it's in the money. If it's in the money, it might cost a little bit more to buy it back, but you free up the stock to move. If it's out of the money and we hold it till expiration, then that option expires worthless. There's no more obligation. You keep the underlying stock. If at some point there is a possibility that the price of that stock might get close to that strike price that we sold, the likelihood of being assigned early goes up. Now, one of the reasons why somebody might choose to exercise their right to buy the stock from us, and we would have to meet that obligation, would be they wanted to collect the dividend. Because when you own the call option instead of owning the underlying stock, you don't get the dividend. The only way you get the dividend is if you exercise that call option and turn it into shares of stock. So we looked at the chart here, We saw that there was just a dividend payout. So we're not in that time frame where we're likely to see another dividend payout before this option expires. So already we've reduced that probability or likelihood that these shares get called away from us for somebody wanting to exercise that option early. So it's, again, not something to be afraid of. Just be aware of that fact that there is the possibility that those shares could be called away. If they are, great. You own the underlying shares, you turn around and buy the shares back and continue to go on your way because you answered the question, am I really, truly, honestly willing to sell the shares of the underlying stock if I get called away? And the answer is yeah. If that's the answer, then it's not something to fear, that early assignment. All right, that's one way to approach this. I want to look at one other one because this is a $200 stock. Not a lot of volatility, but I did want to look at one other strategy here, or one other idea. Let's take a look at this stock, AMD. And this is a stock that has high implied volatility. And that implied volatility right now is up around that 75% level. It's been moving in a very strong bullish direction, and it's a higher price stock. So the premiums received are perhaps going to be a little bit higher. But you notice something, you don't see those green circle icons with the dollar sign. This is not a dividend paying stock. So that reason for an option trader buying call options on AMD in order to perhaps convert those call options into ownership of the stock to collect the dividend, that possibility is removed from this scenario. But there might be other reasons why an option buyer might choose to exercise early. But we're going to look at this from that perspective of saying, hey, I own this underlying stock, and in this account I have shares. Again, not a recommendation, but looking at bringing in some additional premium to offset the fact that it doesn't generate a dividend, maybe. And it's got fairly high implied volatility. So you can see where that implied volatility is. We're post the earnings announcement. So I'm going to just kind of bring these back down. So some traders might look at this and say, wow, this is making a big move to the upside. From a technical perspective, how do you find a level of resistance on something like this? This is where you maybe start drawing some connecting dots. Maybe we're at a level of resistance right now. You start to connect those lines. Maybe we've got some resistance overhead, maybe using Fibonacci's or something else as a means. But this is where going back to that delta could be a help as well. So we're going over to the trade tab, and we're going to look at AMD. And this is something, since implied volatility is a little bit higher here, that some traders might go to the shorter end of this perspective. So I'm going to go to the 18 June expiration, 23 days to go until expiration. And we're going to go to the strike prices here and look at the kind of premiums. Now, this stock is twice the cost, twice the price at the moment of that Johnson & Johnson stock that we looked at before. This is trading at almost $500 a share. So our premiums are going to be more. But remember, also implied volatility is higher. So this is where we can afford, perhaps as an option seller, to sell a little bit further away from the price of the stock. So the stock's currently trading at $496. We'll call it 500 for easy math. And if we were to come out to the 30-cent delta as a starting point, that's got a dollar-wide bid-ask spread on it. These are a little bit wider bid-ask spreads. So that might be a reason to maybe look around a little bit. Maybe we look at this 12 June and go a little bit shorter even in terms of time frame. We're going to get less premium, but our bid-ask spreads, wow, are worse. They are a little bit wider here. And again, that's one of the reasons why volatility is a concern. Maybe we go to the 26th June expiration, 31 days. And those are a little, well, maybe they're not a little bit better. Those are a little bit wider here. This is a very liquid stock, but it's got a lot of volatility, which means that those options are going to be fairly wide. So I'm going to go back to that 18 June, 23 days to go until expiration. And we're going to do with what we've got here. I'm going to go out to the 30 delta, and we're going to look at selling that 30 delta option. So dollar-wide bid-ask spread. And again, if our intent here is just to bring this premium in and then close this trade down as we get closer to expiration by buying it back or letting the shares get called away. You know, if I can sell, look, if I can sell the shares 60 points higher, because that's where it's sitting at right about 500 bucks. If I were called out at 560, I'm selling the shares at $60 higher, plus I'm bringing in $15.70 of premium. Wow. I mean, that's not such a bad deal. Now, I'm not suggesting that's not a recommendation. I'm just saying you got to put it into perspective. Because if I'm going to get called out at $60 higher from where the price of the stock is right now, that might not be such a bad deal. So I'm going to look at selling this. Again, we're going to click on confirm and send, read through this order. We're bringing in 1,500 bucks. It reduces my premium. I just want to make sure I know where I have the shares of this stock in this account. I think I've got it down here, AMD, right here, 100 shares of AMD. My cost basis on this stock is 200 bucks. That's where I bought it, was at 200. So it's more than doubled in price. So I'm going to be aware if that's a situation that might trigger a taxable event, a substantial taxable event. So that's where, again, I have to ask that question. But I'm going to go ahead and put this trade on. That's in my unallocated group. So we're going to go back to our trade tab. We're going to fire this order off. I'm going to put it in my unallocated group. So this is just going to be right there in that group. And we're going to click on send. We're going to fire that order off. We sold it for $15.70. And we got to come back down here to our monitor tab. We'll take a look. Here's our AMD trade. Short one contract of the 560 call. That's where our obligation lies. And we've got long 100 shares. And our expectation is that the price of that option is going to come back down as time decay continues. Because remember, we looked at that trade here. We sold this one right here, 72 cents per day of time decay. And if implied volatility falls, 43 cents per percent is going to go away from our option premium if implied volatility goes down. Now, time's not going to reverse, but if implied volatility continues to go up, that could work against us. But the passage of time in this particular case is going to work in our favor. So Goku asks the question, price of the stock goes up and down. The price has gone past the break-even point, fell below the strike price at expiration. Does the buyer have the right to call the shares? The buyer has the right to call the shares at any time. The buyer of the call option. As a seller of the call option, we've got that obligation as long as that option is live. Yeah. So do I think selling shorter dates reduces the likelihood of being called out? I think it actually increases it because you have less extrinsic value, but you could always close this down. We could always come back down here and right click and create either a closing order and just eliminate the obligation, or we could create a rolling order which buys it back and then sells another one further out in time. So it gives you more opportunities perhaps to adjust and continue to, but it requires more attention. Attention must be paid when selling covered calls. These are not, there is no option strategy that I consider to be a set it and forget it type of strategy. Even though a covered call is oftentimes viewed that way by many traders, it is not. It still requires your attention to be focused on what you want to accomplish in this strategy. So let's pop back over here real quick and review a couple of things. The exit signals, buy it back if the call's dropped by 50 or 80% and there's not very much premium left to be had, buy it back and then sell another one. Roll it by buying it back and selling another one in one transaction. Close it in time entirely. If the price of the stock's going down, buy back the call option first so that you eliminate the obligation and then sell the underlying stock. Or if it's going up, just let it get assigned. That's not, because remember, you answered the question, am I really, truly, honestly willing to sell these shares of this underlying stock? And that may be the circumstance, right? All right. So a couple of other resources. We defined a covered call, talked about those. We looked at basics for stock selection, option selection, entry and exit, and we placed a couple of example trades. I want to give you one resource here. Come back over here to the Trader Talks webcast page on YouTube. Give us a click on that subscribe button when you do that. But if you type right here, covered calls, we teach on Mondays a covered calls and short puts webcast. That's Mike Fairborn who teaches that. And so he talks about variations of this particular strategy on an ongoing basis. So that's a great playlist to jump into if you want to look at some specific strategy ideas around covered calls. Now, next week, we're going to talk about buy rights, where we don't already own the underlying stock, but we sell a call option and buy the underlying stock at the same time for the purpose of creating a covered call trade. So again, some resources. So what I'd like you to do between now and then is search for stock candidates that you might consider to buy the underlying stock and sell a covered call against. And we're going to be coming back with that next Tuesday to talk about that particular strategy. Wiley's got it right there, getting started with options next Tuesday. So once again, my thanks to Michael Fairborn for helping out. Guys, this is a strategy that is kind of the building block for a lot of things that we do. So thank you for being with us, for the great comments and conversation that's been going on. My thanks to our great production staff and our reviewers for helping out as well. And we will see you guys again. I'll be back later this afternoon teaching getting started with technical analysis. So we'll see you then. Take care, everybody. Bye-bye.